This is the Average Guy Network, and you have found Financial Tech and the Guide Rock Capital Management Weekly Commentary for the week of June 17th, 2013. I'm your host, Jim Collison, broadcasting live from the AverageGuy.tv studios here in Bellevue, Nebraska, and we post the show, including the written commentary, each week out at the AverageGuy.tv. Financial Tech brings you the latest market commentary from the award-winning Andrew Hunt, CFP and president of Guide Rock Capital Management, located here in Omaha, Nebraska. If you'd like to receive a free copy of the written commentary, I get one of those each week. Thank you, Andrew, for doing that. You can get them in advance. Just send us an email at andrew_hunt@guiderockcapital.com. and put subscribe in the subject line. He'll know what to do with that. And if you have questions or comments or anything we can read or answer on the show, send us an email. Just send that over to Andrew, andrew_hunt@guiderockcapital.com. And, of course, you can find us both on Twitter. Andrew is just Andrew D. Hunt, and I am at J. Collison. Andrew, great to have you this week. What do you have for us?
Good to be here. Good to be here. Good to be back in Omaha as well. So I've been on the road a lot, as our loyal listeners will remember. But this last week, the International Monetary Fund, the IMF, put out their performance of the U.S. economy for the world to review and gnaw on a little bit. And, when it put that annual review out there, it stated that, quote, despite some improvements in economic indicators, particularly in the housing market, the very rapid pace of deficit reduction is slowing growth significantly, believe it or not. U.S. growth is expected to slow to 1.9% in 2013 from 2.2% back in 2012. This projection reflects the impact of the sequester, which is the $85 billion of automatic U.S. government spending cuts, and the expiration of the payroll tax cut and the increase in tax rates for high-income taxpayers. Growth could pick up to 2.2% next year, with a more moderate fiscal adjustment and a further strengthening of the housing market. The IMF also said that the Federal Reserve should continue quantitative easing through 2013. That's pretty interesting stuff. I think if you read that quote, you found out in there that the IMF is actually saying that a reduced U.S. federal deficit is bad for the economy going forward, for growth, I guess I should say, for economic growth. It's not the only pondering going on right now about the Fed's quantitative easing program. The major U.S. stock market indices finished the week lower. The Dow Jones fell 1.2% last week. The Standard & Poor's 500 index was off by 1%. The NASDAQ, the tech index, dropped by 1.3%. And remarkably, last week was crazy. The Dow experienced 4 straight days of triple-digit swings. As you might have known if you watched the news today, the Federal Open Market Committee meeting was held yesterday and today, and then there was announcements today as well, and actually Monday as well. Very few people expected the Fed to announce that it will reduce the pace of bond buying immediately. Most economists surveyed thought that the Federal Reserve will begin reduce bonds purchases by early fall. And of course today, Ben Bernanke continued to indicate that that is the case, and markets fell because of that, which continued to just kind of blow my mind, because one would think that the U.S. economy not having to purchase so many bonds artificially would be good, but in fact it's actually hurting stock markets, and growth projections are hurt as well. So switching gears here a little bit, when we think about renewable energy, it kind of sometimes feels like emerging markets, emerging countries are leading the way. According to UNEP's report, the Global Trends in Renewable Energy Investment 2013, quote, renewables are picking up speed across Asia, Latin America, the Middle East, and Africa, with new investments in all technologies. Markets, manufacturing, and investment shifted increasingly towards developing countries in 2012. For instance, after running even with the United States during 2011, China became the dominant country for renewable energy investment in 2012, according to the report. It's really interesting. If some of you who are in the Midwest might remember, and this is kind of my inspiration, The last couple of years, as you drive across the Great Plains states, you see a ton of windmills. I was flying over Illinois last week, looking out the windows and just admiring it, all the amazing technology out there. But even though that quote that I just mentioned about China surpassing the United States, it doesn't necessarily mean that we're not in the race, the U.S. According to The Economist, an analysis by Bloomberg New Energy Finance found that the U.S. and China traded about 6.5 billion with a B dollars in solar, wind, and smart grid technology and other services during 2011. America sold about $1.5 billion more to China than it imported. So The Economist concluded American ingenuity is required to supply Chinese factories with such things as polysilicon and wafers for photovoltaic cells and the fiberglass and control systems used in wind turbines. So what does the future hold? Well, Kiplinger's letters said solar power production will double in 2013 and move ahead of geothermal power as a source of clean energy. They believe that wind energy will soon rival hydroelectric power as well, which is interesting. And for those of us in the Great Plains, hello, that's a lot of stuff going on out here. The United States added more wind power capacity last year than any other type of power generation. Currently, wind comprises about 5% of power generated in the United States. So global investment in renewable energy may have fallen during 2012, but that doesn't necessarily mean the industry has lost momentum. Renewable energy is gaining share in a growing number of countries and regions, including the European Union, where renewable energy, primarily solar and wind power, accounted for about 21% of electricity consumption in 2011 and almost 70% of new electric capacity in 2012. So renewables just may prove to be the tortoise in the energy race. So then, as we end every week with our quote of the week, this one is from good old Bill Shakespeare, the English poet and playwright. He says, "It is not in the stars to hold our destiny, but in ourselves."
Very good, Andrew. Of course, you hit a hot button with me when we talk about renewable energy, and I know I drive a hybrid, and we work real hard here at the Collison House to try and do what we can to leave the economy or leave the environment better than we found it. That's just one of the things that we try and do here. I saw an interesting PBS special with an energy expert. He divided our energy consumption here in the United States and around the world into 7 different sections. And he really had a unique approach to it. And he was, in the next 25 years, we really just need to stop, not reduce, but just stop the current fossil fuel and those kinds of fuel consumption, oil and fossil fuels and those kinds of things. But just begin to slowly increase that which comes from wind and solar and some of those renewable sources that are out there. And interesting in this plan, because I think sometimes we think we've got to cut all the way back at once to get it done, when really we just need to start replacing, build those renewable sources up and start replacing them. And I too, as you drive out to Colorado, as you go into Colorado Springs, you come up over the hill and you just see wind turbine after wind turbine, and it's kind of a great scene. I've been encouraged that the Americans have blocked wind production for a lot of years only on the basis of sight. Nobody wanted to see these windmills, right? And I think that's just crazy. We've got to be a little bit smarter than that, and certainly we have areas in the United States that are very windy and can support wind, and those things, somebody's got to buy those things. Somebody's got to make those things, and so that is good for the economy as we put those things together as well. Andrew, one more question for you around going back to the first part of what you were talking about. I think when we talked about the sequester, that went in place, there was some doom and gloom. What effect has it had on the economy? There's certainly, it has slowed, but has it slowed as much as people thought? Is it slowing faster? What's kind of been the thought out there, among the economists?
That's a really great question. I was at a conference earlier this month where one of the chief economists from University of Missouri at Kansas City spoke, and she's an economics teacher. Really impactful stuff, and she talked a lot about how the U.S. economy is kind of counterintuitive. When we tend to think about the U.S. economy, we tend to think about our personal balance sheet or our personal finances, because that's what we relate well to. But actually, the U.S. economy functions nothing like that, because there is no such thing as printing money in a personal household when that is actually a real thing in a government. And so one of the things that she talked about that was really hurting the economy is this sequestration. It is the slowing of the bond buying. In her opinion, she thought that we really needed to be spending more, investing more as a country, and that would drive growth. We are seeing a little bit of slowing, although there are mixed signals as we've been talking about on here on this program for the last several months. Great housing reports, but consumer sentiment might be falling, and vice versa in any given week. So it's really interesting to think about and to talk about, but right now I think it might be too soon to tell. I'll tell you, the markets hate the idea of slowing down quantitative easing, and markets tend to be a leading indicator, and if they hate it too much, it could be really bad. So we'll see.
All right. Good enough. Well, we want to thank everybody for coming out tonight. We'll kind of wrap up this live part of the show. If you are listening, you can join us over at theaverageguy.tv/live. Andrew, take a few questions right after the show. If you listen to the recorded version, you can join us if you watch my Twitter account, @JCollison. I'll oftentimes announce when Andrew and I go live. We don't go live at the same time. With our schedules, it's really difficult to do that. We don't go live at the same time every week like a lot of shows. But if you do want to catch that, follow me on Twitter @JCollison, and I will tell you when we are going live with the show. Sometimes you just have to respond really quickly to that. And I'll let you know if you're new to podcasting and you're looking for an easy way to listen each week, you might want to consider using Stitcher, available on any browser as well as both on the Android and iPhone platforms. It's a great way to listen to your podcasts both at home and on the road. This show and all the past shows are on Stitcher. Stitcher.com, just search for financial tech, and that works really well. I tried that again. About twice a week I check it just to make sure that the search is working. Stitcher, it's education for your ears. And be sure to visit Guide Rock Capital at guiderockcapital.com. Follow Andrew on Twitter @AndrewDHunt, and get all the show notes to this show, the ones that Andrew posts early in the week, out at theaverageguy.tv if you just want a copy of it. And that would be theaverageguy.tv/FT032 for this show. Now, Andrew and I say thanks for listening. We'll catch up with you next week. Remember, be smart about your investing. All right, man. Let's see. Anything else? No questions from chat. So the indices, the markets just kind of continue to wobble in there, kind of a little bit up, a little bit down, a little bit up, a little bit down. Is that maybe 1% either way? Is that kind of the way it's been the last couple of weeks?
It has been, yeah, but the macro trends are pretty clean, but the day-to-day has been just
all over
volatile. Yeah, I mean, yesterday the market's up 1.1%. Today it's down 1.1%. I mean, the volatility is just brutal out there.
That always begins to worry me when it gets, it seems like we have this pattern of a straight line, not straight line, but we shoot up, and all this exuberance, and then it begins to wobble a little bit, and then they get really big variances, like way up, way down, way up, way down. And then
and it's like you almost feels like you can predict it because the last 3 summers in a row it's been just like this.
Yeah.
We come out of the spring super hot, and then the markets go super volatile all summer, and then we roll into September, October, November, things cool off a little bit, and we skate into the end of the year. So I think people sitting on the sidelines who aren't professionals, they probably look at this and go, man, I don't want to invest in this market. This is crazy. I could lose 1% by choosing to invest on Monday rather than Tuesday.
Yeah.
You can't blame them. You kind of got to say, well, that's why you got to take that balanced approach that you mentioned earlier and tiptoe in.
Well, and the effect of dollar cost averaging into a wobbling market, is that good enough? Does that even it out in the long run during these wild swings? If I'm dollar cost averaging in other words, I'm making consistent purchases every single month or twice a month through my 401k, is that even it out?
It should over the long term, right? So we're talking about 5-year time horizons or more. It should even out, but it's really in volatile times, I think it probably would be even better to buy more, right? Because really you're getting that average cost, and that kind of the definition of dollar cost averaging, right? Getting
Yeah.
that average cost, and you're still subject to some of that risk that, if your monthly draft is set up to be on Wednesday, um, and the market just happens to be up, guy almost wonders if maybe he should buy every week through the summers here lately, but I don't know. It's probably kind of like market timing at this point.
Yeah, it's kind of crazy. Hey, we got a quick question. You got a minute to stay for a quick question? So,
Yeah.
so Ant Pruitt in chat says, seems like there's been some drawbacks on renewable energy investments. Example, aren't the price of hybrid vehicles and other green tech somewhat expensive? Do you think consumers will buy green?
Yeah. That's a great
It's
question.
the $1 million question, right?
That is the $1 million question.
Yeah.
Well, you look at a company, God, I love Tesla Motors. In fact, I love anything Elon Musk does. So he happens to also own the world's largest solar energy company, right? So if you're out in California, you know what I'm talking about because you see them everywhere. So they install all the photoelectric mirrors on people's roofs out there, and he's found a way to make it work. Now the Model S is still expensive, right? But you can lease it for $780 a month, which is expensive. But they're also kind of taking a luxury bent at it. So it's kind of like buying a Mercedes that also happens to be run on batteries. He's done the same thing with the solar power deal. He's made the barrier to entry very, very low. So if we can find more innovation that way, where things become cheaper and you still get high quality type products, I think that's the secret sauce. But if you go out and buy a Toyota Highlander hybrid, it's $15,000 more or $10,000 more than the regular electric car. So we're seeing a lot of people, or regular gas car. So we're seeing a lot of people even buy diesel cars instead of which is, in my opinion, not that much better.
No, not anymore.
Mileage.
Diesel's so expensive.
Yeah, and it's dirty, and so if you're really worried about the environment, it's just you're trading cost.
Yeah.
So I think that's the $1 million question. How will people afford it, and how will it really catch on? And a lot of the government subsidies have fallen off too. Back in 2010, a lot of the money that was being spent was as subsidies for these wind farms and stuff, and that's fallen off. And so these guys are now kind of feet to the fire trying to figure out how to make it work. It's gonna be interesting. I don't know the answer to that. It's a great question.
Yeah, and so his follow-up question is, what does that mean for investors in as far as making and I think maybe he's talking about how do we approach investing in these companies, not just purchasing the products. So I think what you said is great as far as when we talk about the consumer side of things, and I agree with you. It's tough. It's a tough sell, although it's gotten better. I think purchasing green has gotten easier, and I think over the next 10 years it will continue to do that. Andrew, talk about it, maybe investing in some of those companies that are into
so I think the way it works, I think the way to take advantage of it is you got to look for companies that are big enough to have the scale to make it work. I think we kind of have this sexy dream of finding the next startup that's going to come out of nowhere and blow up. But this is almost like utilities, right? To make this work, you need huge economies of scale. So we got to be looking to companies, utility companies, places like General Electric, places like IBM, some of these huge companies that have lots of cash to throw at this problem. And I think that's probably where investors can find some opportunities, is looking for big companies that are willing to bet on it. And then I think the other piece is, if you look at what's happened with shale and shale gas in North Dakota and Texas, the way to take advantage of that, right, is with strategic purchases in land. Not so much the companies themselves, not so much the natural resources, the commodity, but really it becomes a play on downstream service providers, land, and not necessarily the companies themselves, because they're kind of fly by night. So you got to watch that and really keep your nose to the stone, because I think sometimes it seems like, well, gosh, maybe I should just go buy in this private placement or this master limited partnership or some of these crazy ideas that come across the table for investors, but you might get burned in those scenarios. And so you really want to watch. Look for the downstream people that are servicing the bigger companies that are doing the drilling and things like that for shale gas, because those companies probably have a little bit more sustainable business model, and I think could be a good opportunity for eco-friendly investing outside of normal channels.
Yeah, Andrew, what do you see these green companies, renewable energy companies? Do you see them as a separate segment in the market? Can you separate them out and kind of put them in their own category? So if we were talking about a risk category or something like that, do you separate those out, those kind of companies?
Not yet.
Okay.
It's not too prolific. There's not enough big energy companies that are really plowing ahead. What we're seeing these big energy companies do is they're investing in natural gas, they're investing in shale, so we're not seeing a lot of them go build wind farms. We're not seeing a lot of them hit on solar yet. So I don't think it's prolific enough yet. Now, of course, there's this whole emerging field of socially responsible investing. There's tons of new products coming out around that, but that's also avoiding other quote-unquote sin type investments, also looking at corporate governance and things like that, not just eco-friendliness. So
yeah, good stuff. I think along those lines, all those energy sources that we just talked about are all finite, right? I mean, the planet's only so big. There's only so much gas. There's only so much oil in the ground. There's only so much natural gas. Eventually, as supplies run short, price goes up, and really renewable will make sense when the fossil fuel or the natural gas is more expensive than putting photovoltaic on your roof.
And that's why shale works.
Yeah.
The shale gas works because regular gas is so expensive. I heard that if gas were to fall, normal light sweet crude were to fall below what we experience on the end at $3 a gallon, if it were to fall below that, then the shale gas wouldn't work. It wouldn't be economically viable anymore.
Yeah.
Pretty interesting.
Yeah, it is interesting. We live in interesting times, and I think as we move forward, it's a very complex. It's a very complex market, I think, and the way everything is tied together, very global in the sense. You mentioned at the front of the show, China really starting to pick up the pace on putting some of those things in. I think they realize, they're kind of living in our 1970s right now, right? I mean, polluted air and smog and horrible work conditions, and they would be wise to look to the United States and say, oh, maybe we should not repeat the sins of the past, and realize what we went through and the enormous amount of money we spent to clean that up. Now, a lot of sins have already taken place over there, and they've got some cleanup to do in years ahead. So it'll be interesting to see how they're responsible in that. Or is the market in China still roaring, or has it kind of settled down as well?
We started to see some slowdown, and we've talked about it on the show here a little bit. Some indications of slowdown, right? Now it's all relative. For China, they were experiencing GDP growth in the double digits, and even so slowing down to 8% growth would be significant over there, which is what they're projected to do. And so when we talk about U.S. GDP growth at 2%, kind of boggles the mind. But yeah.
Okay. Well, I'll remind folks that it looks like that's the questions for the night. If you got to the end of this show here on YouTube, congratulations. We normally go about 15 minutes each and every week. You can catch those out at theaverageguy.tv. And if you want a specific show, just put FT. That's short for financial tech. And then this episode is 032. Andrew, I might even just I'll edit this up a little bit and tag it on the end of the regular show for folks, and they can get. I think you had some good words in there, so we'll add that in as well. And we'll say thanks. If you're out there on YouTube, thanks for watching us. Appreciate you coming out tonight. We do it every week. Just to subscribe to it over at theaverageguy.tv. Thanks, guys. Hang tight for a sec, Andrew. Guide Capital Management, Inc., or Guide is a registered investment advisor that is registered with the state of Nebraska and located in Omaha, Nebraska. Guide and its representatives are in compliance with the current registration requirements imposed upon investment advisors in the states in which they maintain clients. Guide may only transact business in those states in which it is registered or qualifies for an exemption or exclusion from registration requirements. Important information describing GuideRock's business operations, services, and fees can be viewed on the SEC's website at www.advisorinfo.sec.gov. GuideRock will provide Form ADV Part 2, which serves as the firm's disclosure document to all clients. Copies of Form ADV Part 2 are also available to interested parties upon request. All investment strategies have the potential for profit or loss. Past performance is not indicative of future results. No current or prospective clients should assume that the future performance of any specific investment strategy, or product made reference to directly or indirectly on this video, website, or indirectly via hyperlink or any affiliated third-party website will be profitable or equal to past performance levels.